we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. And by 2050, $50,000. Well, something's going to happen to the currency before then, whether it's replaced by a new currency or there's a complete failure or a spiral out of control. I don't know. But my feeling is something's going to go wrong before we get to 2050 and see $50,000 gold price.
Gold's long-term direction is entering a moment of heightened importance, a point emphasized by analyst Clive Thompson, who notes that the forces shaping the metal today echo patterns seen during previous periods of monetary strain. After decades of expanding money supply and an accelerating government debt load, the environment surrounding gold has grown increasingly strategic rather than speculative. Even though forecasters continue to soften their language with terms like might or possibly, Thompson argues that the underlying trend reveals a stronger consensus. Gold's rise is being driven not by short-term enthusiasm, but by deep structural pressures that show little sign of easing. The metal's record over the last half-century reinforces that view. Since breaking free from the fixed $35 price in 1971, gold has proven itself one of the few assets capable of surviving political disruptions, inflation waves, currency dislocations, and corporate failures. Thompson highlights that, unlike equities, which require constant monitoring, rebalancing, and tax-triggering adjustments, gold quietly preserved purchasing power through eras that wiped out entire segments of major stock indices. Its ability to compound without relying on corporate performance or economic cycles remains a defining advantage for long-term holders. What concerns Thompson most today is the rapid escalation of government liabilities. U.S. debt, once a manageable fraction of GDP, has surged past levels that economists previously considered red lines, with interest expenses rising fast enough to pressure future budgets. Current projections indicate that this path is unlikely to stabilize without significant intervention. Historically, when nations reach similar fiscal extremes, the outcomes tend to involve inflation, restructuring, or heavy-handed financial controls, all environments in which gold has reliably strengthened. Thompson believes that as these pressures intensify, gold's role as a protective asset will become increasingly pronounced, particularly for investors seeking stability amid mainstream financial vulnerabilities. Now, we present the clips from Clive Thompson. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
So government debt has expanded massively over the decades. Since 1971, government debt, this is the USA, has increased from $389 billion to around $37 trillion today. That's nearly 100 times as much. And if you look at this chart, on the chart here, you can see the government debt, which is the green area chart at the bottom with a yellow line at the top. And you can see the government debt's been increasing fairly constantly year after year, sometimes a little bit faster, sometimes a bit slower, and it's starting to increase a little bit faster, and it's likely to accelerate away from here, mainly due to the fact that the interest burden is becoming more and more important. Because back in 1971, which is here on the chart, in 1971, the debt to GDP ratio was only 25%. In other words, the total debt of the United States was 25% of their GDP. It was quite manageable. Today, we're at around roughly 100% debt to GDP ratio. It's 4 times as much. In other words, compared to the economy, it's 4 times larger than it was in 1971. And the debt is as big as the entire economy itself. And the Congressional Budget Office predicts that debt to GDP ratio is going to continue to rise. And obviously it can't rise ad infinitum, because sooner or later something will go wrong. It always has in every country in the world where debt has become too burdensome. And on this chart, I'll just adjust it slightly there. On this chart, you can see the green area is the government debt, and the red line is the gold price. Both of these are on a logarithmic scale. So on the left-hand side, we've got the log scale for government debt, and on the right-hand side, we've got the gold price in dollars, also a log scale. And I've drawn a blue line, a straight line here, which roughly matches the past growth in government debt. If it were to continue at the same pace, and I stress that a lot of people think it will accelerate at a faster pace, me included, but if it continues at the same pace, we will see, in all probability, gold keeping pace with the rise in government debt. So what would that mean? It would mean by 2027, we might be looking at a gold price of 5,900. That's a best guess at it. It's not a prediction as such. By 2030, we might be looking at 7,800. By 2040, we might be looking at 18,900. And by 2050, $50,000. Now, I don't seriously think we're going to get to these high numbers because I think the currency something's going to happen to the currency before then. Whether it's replaced by a new currency or there's a complete failure or a spiral out of control, I don't know. But my feeling is something's going to go wrong before we get to 2050 and see $50,000 gold price. But anything is possible. So keep be prepared for the unexpected too. Let's just have a look at the increase in government debt compared with money supply. Now, this is a bit of a more recent chart. It goes from 2004 to, where are we today? It goes from 2004 to 2025. That's it. It goes up to July, in fact. And here you can see the red line is the M2 money supply of the G20 countries. The scale is on the left-hand side, is a logarithmic scale. At the bottom, it's 15 trillion. I should have put the figure in there. And 15 trillion. I think it's trillions. And on the right-hand side, you can see the gold price, which again, I'll just shrink that a little bit. To show you here. Yeah, on the right-hand side, you see the gold price rising from roughly $400 to around $4,000 over the period. So the gold price is keeping pace with the expansion of money supply, it's keeping pace with the expansion of government debt, and those trends, which are almost looking like they're straight line or accelerating, they're not likely to go down, and probably the gold price will continue to keep pace with the rise in debt and money supply. That's what they've tended to do in the past, what the gold's tended to do in the past, and probably what it's going to do in the future. So one of the big problems with US government debt is the interest on that debt. Because the level of debt has risen as a percentage of GDP, so has the interest burden as a percentage of GDP, and we're in a higher interest rate environment than we've been in for the last 15 or 20 years. So currently, the interest being charged or having to be paid on national debt is increasing at quite a fast rate. So in 2021, the interest on the US national debt amounted to $352 billion. That's the figure from the Congressional Budget Office. $352 billion in 21. 3 years later, in 2024, it was more than double at $881 billion. So it's gone from 352 to 881 billion in 3 years. And the interest burden is going to keep rising according to the Congressional Budget Office, their own numbers. It could be worse than they expect. The Congressional Budget Office is forecasting that the US government debt owned by the public will reach 120% of GDP within a decade, and it might go faster than that. When debt burdens rise, history suggests several possible outcomes: higher inflation, restructuring, or some form of capital control. All of these scenarios, if they occur, have historically been supportive of gold.
Recent trends in global finance are drawing heightened attention from analysts as they reveal a structural shift with far-reaching economic implications. Clive Thompson observes that the persistent expansion of global money supply has transformed gold from a traditional hedge into a critical indicator of confidence in financial systems. Decades of mounting government debt and expansive fiscal policies have heightened vulnerability in traditional currencies, making gold a reliable measure of systemic trust. Its movements now reflect deeper concerns about liquidity creation, fiscal imbalance, and geopolitical uncertainty, prompting investors and institutions to rethink portfolio strategies and risk exposure in an environment where conventional assumptions are increasingly fragile. Institutional and private investors are responding to these developments with notable adjustments. Historically, gold allocations were minimal, but mounting concerns over inflation, currency instability, and geopolitical tensions are driving more substantial exposure. Thompson notes that even modest portfolio shifts could stress the market's constrained supply, triggering accelerated price adjustments. Central banks are intensifying bullion purchases to fortify reserves and diversify away from traditional currencies, highlighting growing recognition of systemic vulnerabilities. With demand rising across private, institutional, and sovereign levels, the market is entering a period of unusual alignment, emphasizing how confidence in conventional debt-based systems may be tested under ongoing fiscal and monetary pressures.
We know that portfolios have very little gold in them. It's somewhere in the range of 0 to 1 or 0 to 2%. And most portfolios have no gold at all. But this now appears to be shifting. Some banks and some institutions are starting to come out and say that portfolios should hold a little gold. And hats off to Morgan Stanley. Their chief investment officer favors a 60-20-20 portfolio strategy with gold as an inflation hedge. So basically, he's looking at moving from the traditional 60-40 approach in equities and bonds to a 60-20-20 approach where gold is one of those 20s and replaces half of the bonds. Another bank which has started to recommend gold, and there are a few others, is Standard Chartered. Ray Dalio, you may have seen, has come out and said that investors should have 15% of their portfolio in gold. Whatever the correct figure is, it's clear that the current level of between 0 and 2% is just too little. It's not going to move the needle at that level. You need at least 5%, and 15 or 20% would be a more sensible number. So even if a very small percentage of global assets, that's bonds and equities, rebalances into gold, and there's 300 trillion of these assets out there, it would absorb the entire year's mining supply. How much would have to deviate from those assets into gold? 0.1%, 0.17% would absorb the entirety of the gold mine's annual production. Put it another way, that's 1 part in 600, 1 in 600 of the amount of money in assets related to gold, related to stocks and bonds. So if institutional money starts to flow into these assets, the gold price will move very quickly. Now, if you're considering buying physical gold, one option that I'd like to help try and make it easier for you is my affiliate, which is Gold Bullion Partners in the UK. They provide physical gold, competitive pricing, and you can speak to them on the telephone number below this video. If you have any doubt, look at the Google reviews on Google and you'll see what the Google reviews have got to say. I'm just pointing them out there. It's all 5-star. 104 reviews I see today. That's Gold Bullion Partners in the UK. And you can speak to them for absolutely free of charge on the telephone number below this video. Now, we've got central banks accumulating gold at a record pace. They're buying more than 1,000 tons a year for the last 3 years. And the high prices, the record prices, are just not deterring them. And let's face it, after all, they can print money as much as they like. So why would they care if the price is at an all-time record? They don't care. They just want more. So why do they want more? Why are they buying? Well, they want to diversify away from the dollar, they're hedging inflation, they're preparing for geopolitical risk, and they're increasing their resilience against unforeseen events in the world markets. Who's leading the purchases? Well, we know that mostly the big buyers are the emerging markets. They're countries like China, Turkey, India, Poland, and Kazakhstan, for example. And surveys are showing that around 81% of the emerging market reserve managers expect to increase their official gold reserves over the next 5 years. You can find the results of that survey on the World Gold Council website. Recently, we've seen places like China and Japan effectively reduce their exposure to government bonds, US government bonds, that is, treasury bonds, as a percentage of their GDP. So as their GDP and the US's GDP has gone up, their exposure to gold has increased and their exposure to government bonds has effectively been decreasing. And of course, we've seen on COMEX unusually large deliveries this year. We don't know who is taking delivery because that's secret stuff, but someone somewhere is taking a lot of gold. Now let's move to a more worrying aspect. I'm going to talk about the digital euro, which is about to arrive. The digital euro will be going live next year and will be full-blown by 2027.
Recent indicators point to a growing shift toward tangible assets as a cornerstone of wealth security, driven by mounting government liabilities, persistent inflationary trends, and rising geopolitical tensions. Institutional investors are increasingly recognizing the need to diversify beyond conventional equities and bonds, with portfolio reallocations likely to put significant pressure on the limited supply, potentially triggering swift and pronounced market adjustments. Central banks' ongoing accumulation further underscores perceptions of systemic vulnerability, reinforcing structural demand that could reshape traditional market dynamics in the coming years. Looking ahead, the convergence of heightened institutional interest, constrained production, and evolving financial technologies may create an environment of heightened sensitivity to market signals. Should confidence in conventional debt instruments falter further, rapid repricing across multiple asset classes could ensue, prompting both private and governmental actors to adopt defensive strategies. In this context, wealth preservation may increasingly hinge on tangible, globally recognized, and resilient assets, setting the stage for a transformative period in global financial markets. Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution. Thanks for watching.